folks. It's January 1st, 2026, and the champagne's barely flat. But the market is already drunk on the same old delusion. The S&P 500 sits at forward multiples around 22, the Shiller CAPE ratio pushing 39 to 40, and half the headlines are screaming about the next AI miracle, while the other half whisper bubble. Same story, different decade, and most of you are still going to lose money this year. Not because the market is rigged, but because you insist on being stupid. Stop hunting for bargains, start hunting for quality. Imagine the scene on this crisp January morning in 2026. The S&P 500 trades at a forward price to earnings ratio hovering around 22 to 24, depending on whose estimates you trust, while the Shiller CAPE ratio stands elevated near 40. Levels that have historically signaled caution, if not outright danger. Headlines pulse with the latest AI breakthroughs. NVIDIA's trailing multiple lingers in the mid-40s to high 40s, and the broader AI ecosystem, semiconductors, hyperscalers, infrastructure plays, commands valuations that would have seemed unthinkable only a few years ago. The market is awash in stories of generational opportunities, and everywhere you turn, investors are scouring screens for the next perceived undervalued gem, convinced that snagging a low multiple is the golden ticket to outsized returns. Yet here lies the uncomfortable reality Charlie Munger repeated with unrelenting clarity throughout his long career. A CERC cheap is often the most expensive mistake you can make. The classic trap unfolds with predictable precision. You identify a stock trading at a depressed 1x or 15x earnings. It appears to offer a substantial margin of safety. The price to book ratio looks attractive. The dividend yield tempts, and the narrative whispers of mean reversion. So you commit capital, hoping for a quick snapback to fair value. But as months turn into years, the underlying business reveals its true nature, eroding competitive position, shrinking margins, management that struggles to allocate capital effectively, and no durable economic moat to protect profitability. The bargain never graduates to fair, let alone wonderful. Instead, it lingers in mediocrity, slowly bleeding value or requiring constant rescue. Time, which should serve as your most powerful ally in compounding, becomes a silent adversary, quietly eroding whatever temporary discount you thought you secured. Munger's insight was revolutionary in its simplicity and ruthless in its logic. If a great business at a fair price is superior to a fair business at a great price. The distinction is not semantic, it is arithmetic. A truly wonderful enterprise possesses structural advantages that allow it to reinvest capital at exceptionally high rates of return, often 18% or more on invested capital year after year. These companies raise prices without losing customers, defend against new entrants through network effects or scale, and generate free cash flow that compounds relentlessly. Enter at a reasonable multiple, even one that feels slightly elevated in the heat of enthusiasm. And the passage of decades transforms that entry into an extraordinary bargain. The premium you paid fades into insignificance as intrinsic value surges far ahead of your original cost. Contrast that outcome with the value trap purchased at a rock bottom 8x earnings, but earning only 6% on capital. The initial discount may provide a brief psychological comfort, yet the slow grind of inadequate growth leaves you barely keeping pace with inflation, or worse, trapped in a cycle of disappointment and opportunity cost. In the current 2026 environment, where artificial intelligence enthusiasm has propelled certain leaders to premium valuations, and the broader market reflects widespread optimism about productivity gains, the pressure to hunt for undervalued opportunities will be intense. The temptation to chase dips, rotate into perceived laggards, or overweight cyclical names trading at depressed multiples is almost irresistible. Resist it. Redirect your focus from the surface level price tag to the fundamental quality beneath. Seek those rare businesses that command genuine economic fortresses, brands that customers willingly pay premiums to own, platforms that strengthen with every additional participant, technologies that create insurmountable leads, and cultures that consistently allocate capital with discipline. These are the enterprises that endure market cycles, adapt to disruption, and deliver superior returns over the long horizon. The market will continue to dangle distractions, temporary pullbacks that feel like irresistible opportunities, overhyped narratives that promise quick riches, and bargains that appear too good to ignore. But the disciplined investor recognizes the deeper truth. Real opportunity rarely hides in the discount aisle. It resides in the companies built to thrive regardless of short-term sentiment, the ones that compound value through thick and thin. Once you shift your gaze from price to quality, from bargain hunting to excellence seeking, the entire game changes. You begin to see why the greatest long-term fortunes are forged not by buying low and selling high in frantic bursts, but by owning the exceptional at reasonable terms and allowing time to reveal the true disparity between cost and worth. That shift alone separates those who merely participate in markets from those who master them. Time is the only thing that turns a fair price into a steal. Picture yourself standing at the dawn of 2026 with the S&P 500's forward P/LOE ratio lingering around 20 or 224 and the Shiller CAPE ratio hovering near 3940, levels that have historically preceded periods of compressed returns or painful corrections. The market is awash in optimism about AI-driven productivity gains, yet many investors hesitate, waiting for a better entry point or a deeper dip. Charlie Munger would shake his head at the impulse. The real discount, he argued, is not found in a lower headline price tomorrow. It is revealed through the passage of decades as a truly exceptional business compounds value relentlessly. Consider the mathematics that Munger revered. A high-quality enterprise, one capable of reinvesting capital at 18% or more on invested capital, transforms even a seemingly elevated entry multiple into an extraordinary bargain over time. Pay a 35x or 40x multiple today, and if the company sustains superior returns for 25 or 30 years, the initial cost becomes almost irrelevant as intrinsic value surges exponentially. The premium you paid fades into the background, overshadowed by the power of consistent high rate compounding. In contrast, a bargain bought at a depressed 10x earnings, but earning only a mediocre 6% on capital rarely escapes its mediocrity. The discount provides fleeting comfort, but the slow grind of subpar growth leaves you trailing inflation and opportunity. This is where patience becomes the ultimate differentiator. Most investors interrupt the compounding process, trading frequently, reacting to volatility, or chasing short-term momentum because waiting feels unproductive. Yet Munger understood that the heavy lifting occurs on the back end. A modest sum invested in a durable, high-return business can grow into generational wealth precisely because time multiplies the effect of steady excellence. In 2026 environment of elevated valuations and persistent uncertainty, the temptation to delay in hopes of cheaper entries will be strong. Resist it. The greatest advantage lies not in timing the market perfectly, but in owning quality for the long haul. Once you internalize that time is the silent partner elevating fair purchases into extraordinary opportunities, the noise of daily fluctuations loses its power. The disciplined investor who embraces this truth rarely regrets the decision to act when the business is right, even if the price feels a touch rich in the moment. Moats matter more than multiples. As we stand on the threshold of 2026, with the S&P 500's forward P/E ratio lingering around 22-2024, the Shiller CAPE ratio elevated near 40, levels that echo the most euphoric stretches of market history. The chorus of caution grows louder. Yet amid the valuation anxiety, Charlie Munger's voice cuts through with piercing clarity. The true measure of a great investment isn't how low the entry price appears today, but how impregnable the business's competitive fortress proves over decades. Picture the classic mistake. An investor fixated on multiple snaps up a stock trading at a seemingly attractive 15x or 18x earnings, convinced the discount offers safety. But peel back the layers, and the company lacks any meaningful barrier to competition. Margins erode as rivals flood in, pricing power vanishes, and capital returns dwindle to mediocrity. That bargain becomes a slow-motion value trap where time erodes whatever initial advantage existed. The multiple was never the point. The absence of a moat doomed the outcome from the start. Munger insisted that durable economic moats, those rare structural advantages that protect profitability, are the real source of enduring wealth. A powerful brand that commands premium pricing, network effects that grow stronger with every additional user, switching costs so high that customers stay locked in, patents or regulatory barriers that block newcomers, economies of scale that enable relentless cost leadership. These are the true fortresses. In the AI-driven enthusiasm of 2026, where certain semiconductor and infrastructure leaders trade at trailing multiples in the high 40s, the question isn't whether the price feels rich now. The question is whether the underlying motive is genuine and widening. Consider the Lollapalooza Effect Munger loved to highlight. When multiple advantages reinforce one another, the moat becomes nearly impenetrable. A company with superior technology, massive scale, and disciplined reinvestment doesn't merely survive disruption. It thrives through it. Pay a fair premium for such a fortress, and the compounding of high returns on capital turns that initial cost into an afterthought over time. Ignore the moat in favor of a low multiple, and you're left holding a castle with crumbling walls. In 2026 environment of heightened scrutiny and potential volatility, the temptation to chase undervalued narratives will be intense. Resist it. Shift your lens from the headline price to the underlying durability. Seek businesses that possess real economic fortresses, those that can raise prices without losing customers, defend against copycats, and compound capital efficiently for years to come. These are the companies that don't need to be cheap to deliver extraordinary long-term results. The market will always dangle distractions, temporary dips, overhyped stories, but the disciplined investor recognizes that true opportunity lies not in buying low, but in owning excellence that time cannot erode. Once you prioritize moats above multiples, you'll see why the greatest fortunes are built not on bargains, on barriers that endure. Envy will kill your returns faster than any bear market. As the first trading day of 2026 unfolds, your feeds are already flooded with screenshots, friends, influencers, and anonymous accounts boasting 50%, 100%, even 200% gains on the latest AI breakout. NVIDIA surges another leg higher, a lesser-known semiconductor play doubles in days, and suddenly everyone seems to be getting rich except you. That sharp, visceral sting you feel is envy. And Charlie Munger identified it as one of the most destructive forces in investing. Envy does not merely cloud judgment, it systematically dismantles discipline. The moment you witness rapid windfalls, the rational part of your brain goes quiet. You abandon your circle of competence, chase unproven narratives, overpay for momentum stocks, trading at nosebleed multiples, and justify stretching valuation because everyone else is doing it. In 2026 environment, where AI enthusiasm has already driven certain leaders to trailing P/Es in the high 40s, and forward estimates still reflect explosive growth, this behavior will be amplified. The crowd piles in, pushing prices higher, and the latecomers, driven by envy rather than analysis, become the ones left holding when sentiment inevitably shifts. Munger's antidote was brutally simple: never let someone else's quick gain dictate your actions. He reminded us that markets are designed to separate the patient from the impulsive. The investor who envies rapid windfalls often ends up overexposed to speculative froth, forced to sell at the worst moment when reality reasserts itself. True wealth, he argued, comes from ignoring the noise, sticking to high-quality businesses with genuine moats, and accepting that your path will look boring compared to the speculators' flashing paper profits. Social proof is powerful, but it's also a mirage that lures people into overpaying for mediocrity or outright illusion. In an era of instant gratification and endless comparison, envy feels like the default emotion. Yet the greatest competitive advantage you can cultivate is indifference to others' short-term success. Focus on what you truly understand, buy excellence at reasonable prices, and let compounding, not comparison, do the work. The instant you stop measuring yourself against the crowd's latest winners, you reclaim control over your decisions. That quiet discipline, not the loudest gains, is what separates enduring success from fleeting excitement. Once you master this, the market's distractions lose their power, and the real opportunities, the ones built on patience and rationality, become unmistakably clear. Invert the problem. Ask how to lose money in 2026 with the S&P 500's forward PKE already hovering around 220 to 24, and the Shiller CAPE rate near 40. The market is priced for near perfection. AI enthusiasm continues to fuel sky-high expectations, yet history warns that when optimism peaks, disappointment follows. Charlie Munger's most powerful mental tool was inversion. Stop obsessing over how to succeed and instead ruthlessly map every reliable path to failure. Then avoid them like the plague. The ways to guarantee poor performance or outright losses in 2026 are painfully straightforward. Chase the hottest narrative at any price. Pour capital into the latest AI darling trading at 45 ties or 50 tie earnings. Convinced endless growth will justify the premium forever. Load up on leverage because it's different this time, and margin debt feels safe in a 3-year bull run. Sell and panic at the first real crack. Whether it's a missed earnings whisper, a regulatory shadow, or a simple rotation out of mega caps, locking in losses right when recovery begins. Own businesses without genuine moats, where competitive edges are shallow and copycats, erode profitability overnight. Trade frequently, racking up commissions, short-term capital gains taxes, and the emotional exhaustion of constant whipsaw. Ignore incentives, trust that promoters, analysts, and executives pushing stories are purely altruistic when their compensation is tied directly to inflating the stock. These are not rare pitfalls. They are the well-worn highways that have wrecked generations during euphoric periods. Inversion's genius lies in its simplicity. Once you clearly see the failure modes, the path to reasonable success emerges, almost automatically. Avoid hype, chasing at fantasy valuations, and focus on quality with lasting advantages. Shun excessive borrowing that magnifies downside. Hold through turbulence instead of reacting to every headline. Prioritize companies with real economic fortresses. Minimize trading to let compounding run uninterrupted. Remain deeply skeptical of incentives that favor short-term hype over long-term stewardship. In 2026, when volatility inevitably arrives, perhaps triggered by earnings shortfalls, policy surprises, or simple mean reversion, the investor who has inverted the problem stands ready. The crowd will chase and panic. The prepared mind will stay calm. By first eliminating what destroys wealth, you naturally gravitate toward what preserves and builds it. That single perspective shift, from seeking cleverness to systematically removing stupidity, has quietly powered enduring success for those disciplined enough to follow it. The big money is boring, brilliant. As the calendar turns to January 3rd, 2026, with the S&P 500 trading at forward multiples around 22, 24, and AI-driven optimism still fueling premium valuations across the tech and semiconductor sectors, the market is once again tempting investors with the illusion of quick, clever wins. Everyone wants the secret formula, the perfect timing, the next macro call that will make them look like a genius. Charlie Munger spent nearly a century watching people chase that mirage and concluded the opposite. Extraordinary returns are rarely the product of extraordinary intelligence. They are the quiet, almost monotonous result of owning wonderful businesses at reasonable prices and then doing absolutely nothing foolish for decades. The seduction of brilliance is powerful. Traders scan charts for the ideal entry, rotate into the hottest thematic plays, and convince themselves that one perfectly timed move will change everything. Yet the graveyard of investing is filled with those who tried to outsmart the market. They overtrade, racking up commissions, short-term taxes, and emotional exhaustion. They react to every headline, sell in fear during pullbacks, and buy greedily at peaks. Munger rejected that path entirely. He understood that sustainable wealth is built through the unglamorous arithmetic of high-quality compounding, owning companies that can consistently reinvest capital at superior rates of return, protected by genuine moats, and managed by capable, honest stewards. In 2026, when volatility inevitably arrives, perhaps from earnings shortfalls, policy shifts, or simple mean reversion after years of multiple expansion, the temptation to seek shortcuts will be overwhelming. Resist it. The real edge lies in boredom by excellence. Pay a fair price, even one that feels slightly stretched in the moment, then sit on your hands. No constant monitoring, no frantic adjustments, no reacting to every whisper of disappointment. Let time and the inherent power of a great business do the heavy lifting. A company earning 20% on capital over 30 years turns a modest initial investment into something remarkable, not because you were brilliant at entry, but because you were disciplined enough to stay invested. This is the hardest part for most people, accepting that success looks ordinary. No flashy trades, no viral predictions, no overnight riches, just steady, rational ownership of quality year after year. Munger proved it works. Berkshire Hathaway's extraordinary record was not built on genius timing or secret formulas. It was built on patience, rationality, and the courage to be unexciting when everyone else was losing their minds. In a world obsessed with speed and spectacle, that quiet discipline remains the ultimate competitive advantage. Once you embrace the boring truth that big money rewards the patient rather than the brilliant, the path forward becomes remarkably clear. The market will always offer distractions, but the investor who chooses consistency over cleverness rarely regrets it.